Scene script. Have you ever wondered how the stock market works? Well, let's unravel this financial mystery together. At its core, the stock market is a marketplace. It's where people come to buy or sell shares in a company. But what exactly are these shares? Picture them as tiny slices of a company's value. When you buy a share, you're essentially buying a piece of that company, making you a partial owner, no matter how small your share might be. Now, why would a company want to slice up its value and sell it off? The answer is simple: to raise capital. It's a way for companies to gather funds without taking on debt. They sell these shares to the public, and in return, they get cash that they can use to grow their business, fund research, or even pay off their debts. But how do we determine the price of a stock? That's where the beauty of supply and demand comes in. If a company is doing well, more people will want to buy its shares, driving the price up. Conversely, if a company is underperforming, the demand for its shares may decrease, causing the price to drop. This buying and selling of shares happen at a place called the stock exchange. Picture it as a bustling marketplace. But instead of fruits and vegetables, people are trading shares of companies. There are several stock exchanges around the world, like the New York Stock Exchange or the London Stock Exchange, where millions of shares are traded every day. But remember, the stock market isn't just a place to make quick money. It's a platform for companies to grow and for investors to build wealth over time. It's a financial ecosystem that thrives on the collective belief of all participants in the potential of businesses to grow and prosper. Knowing these basic principles will help you understand the mechanics of the stock market. And with this understanding, you're now ready to dive deeper into the world of investing. So let's embark on this journey together. Now that you understand the basics, how do you get started with investing? It might seem like a daunting task, but it's a journey that begins with a single step. First off, you need to set your financial goals. Ask yourself, what am I investing for? It could be for your retirement, your children's education, or maybe you're planning to buy a house in the next decade. Whatever it is, having a clear goal in mind will help guide your investment decisions. Next, it's crucial to determine your risk tolerance. How much risk are you willing to take? Are you a daredevil ready to ride the roller coaster of high-risk stocks? Or are you more of a safety-first kind of investor who prefers the steady growth of bonds? Understanding your risk tolerance will help you choose the right investment options for you. Once you've clarified your goals and risk tolerance, it's time to open a brokerage account. This is your gateway to the investment world. There are plenty of online brokers out there, so do your research and choose one that fits your needs and preferences. Now, let's talk about diversification. It's a fancy word that simply means don't put all your eggs in one basket. By investing in a variety of assets, you reduce the risk of a single investment dragging down your entire portfolio. So, spread your investments across different asset classes like stocks, bonds, and perhaps even some real estate or commodities. Lastly, keep a long-term perspective. The stock market may fluctuate from day to day, but over the long run, it has historically trended upwards. So don't be discouraged by short-term losses. Stay the course and remember that investing is a marathon, not a sprint. Remember, investing is not about getting rich quick, but about growing your wealth over time. And with these steps, you're well on your way to starting your investment journey. So how do you decide which stocks to buy? The answer lies in thorough research. Diving headfirst into the stock market without doing your homework can be a risky move. It's like setting sail on a sea without a compass. But fear not, we're here to guide you through the process of researching stocks. Firstly, it's crucial to keep up with financial news. This is where you'll get a pulse on the market trends, understand the economic climate, and hear about any significant events that could affect your potential investments. Be it a new product launch, a merger, or a sudden change in leadership, every piece of news can have a considerable impact on a company's stock price. Next, you'll want to delve into the company's financials. This might sound daunting, but it's not as complicated as it seems. You'll want to look at the company's earnings, its debt levels, and its cash flow. A company with consistent earnings, manageable debt, and strong cash flow is typically a good sign. Remember, numbers don't lie, but numbers aren't everything. Understanding a company's business model is equally important. You'll want to know how the company makes money and if its products or services are likely to stay in demand in the future. A company with a solid business model is more likely to withstand market fluctuations and deliver long-term returns. It's also a good idea to compare the company with its competitors. Is the company a market leader? Does it have a unique selling proposition? Or is it struggling to keep up with the competition? These are all questions that could influence your investment decision. And finally, don't forget to factor in your own financial goals and risk tolerance. Are you looking for a quick return, or are you in it for the long haul? Are you comfortable with high-risk, high-reward stocks, or do you prefer a safer, steadier investment? These personal factors will play a big role in choosing the right stocks for you. Being an informed investor is a key step towards successful investing. Investing in stocks comes with risks, but it also has the potential for rewards. Now let's delve a bit deeper into this concept. When you make an investment, you're putting your hard-earned cash on the line in the hopes of gaining more. This potential gain is the reward you're seeking. However, the flip side of that coin is risk. The risk is that instead of gaining, you might lose some or even all of your initial investment. Think of it as a seesaw. On one end you have risk, and on the other, reward. As the potential for reward increases, so too does the risk. But don't let that scare you. It's all part of the game, and there are strategies to manage that risk. One such strategy is diversification. Picture your investment portfolio as a pie. Instead of filling it with just one type of pie filling, diversification means you have a variety of fillings. In the world of investing, this means spreading your investments across different types of assets, industries, and geographical areas. This way, if one slice isn't doing too well, the other slices can help balance it out. Another strategy is setting a stop-loss order. This is like a safety net for your investment. You set a predetermined price at which you're willing to sell a stock if its price begins to fall. It's a way to limit potential losses and keep your risk in check. Remember, though, that these strategies don't eliminate risk. They just help manage it. Investing always involves some level of risk because the future is inherently uncertain. But here's the thing. Risk isn't necessarily a bad thing. It's the reason why investing has the potential for high returns. If there were no risk, there would be no reward. The key is understanding the balance between the two and making informed decisions about where you're willing to place your bets. Managing risk is an essential part of investing. So, as you venture into the world of stock market investing, remember to keep an eye on both the potential rewards and the risks. Should you invest for the long term or the short term? Now that's a question that often puzzles new investors. Let's explore these two strategies and help you decide which one aligns best with your financial goals and risk tolerance. First up, long-term investing. This is the strategy where you buy and hold stocks for several years. Think of it like planting a sapling and waiting for it to grow into a mighty tree. This strategy is based on the belief that although the stock market can be volatile in the short term, over the long haul, it tends to increase in value. The pros of long-term investing are quite appealing. It requires less time and effort as you're not constantly monitoring the market for buying and selling opportunities. It also allows your investments to compound over time, which can significantly boost your returns. Additionally, long-term investments tend to attract lower taxes compared to short-term investments. However, long-term investing isn't without its drawbacks. It requires patience and your money could be tied up for years. Plus, there's always the risk that the companies you've invested in could underperform or even go bankrupt. Moving on to short-term investing. This strategy involves buying and selling stocks within a short period, sometimes within a day, week, or a few months. Think of it as a high-speed race, where you're constantly looking for opportunities to leap ahead. Short-term investing can offer quick returns and the thrill of active trading. It also allows for more flexibility as you can adjust your portfolio according to market trends. But it's not all roses. Short-term investing requires a significant amount of time and knowledge. It also carries higher risk and can lead to stress due to constant market fluctuations. Moreover, the profits from short-term investments are usually taxed at a higher rate. So the question remains, should you invest for the long term or the short term? Well, there's no one-size-fits-all answer. It really comes down to your financial goals, risk tolerance, time commitment, and investment knowledge. Whether you choose to be a long-term or short-term investor depends on your financial goals and risk tolerance. Even experienced investors make mistakes. What are some common ones to avoid? Let's dive right in. One common pitfall is putting all your eggs in one basket, or in other words, not diversifying. Diversification is like spreading your bets across the table. It's a risk management strategy that mixes a wide variety of investments within a portfolio. This way, if one investment takes a nosedive, others in your portfolio can help cushion the blow. So, don't get caught up in the hype of a single stock or sector. Spread out your investments. Another common mistake is trying to time the market, an attempt to predict the future of stock prices. More often than not, this strategy backfires. The market's movements are unpredictable in the short term. Instead of trying to time the market, consider a strategy called dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market conditions. It can lower the impact of volatility on the overall purchase. Then there's the pitfall of letting emotions drive investment decisions. Fear and greed can be powerful motivators, but they rarely lead to sound investment strategies. For instance, in a market downturn, fear might push you to sell your stocks, potentially at a loss. On the other hand, when the market is doing well, greed might entice you to buy more, possibly at inflated prices. Try to keep emotions in check and stick to your investment plan. Moreover, don't neglect the importance of continuous learning. The world of investing is always evolving, and staying educated is key to navigating it successfully. Read widely, follow market trends, and don't be afraid to ask questions. Finally, remember that investing is not a get-rich-quick scheme. It's a long-term game. Patience and consistency are crucial. Don't expect immediate returns. Instead, focus on building wealth over time. Avoiding these common mistakes can help you be a more successful investor. So, keep these tips in mind as you continue on your investment journey. The road to financial freedom is rarely smooth, but with knowledge, strategy, and a cool head, you can navigate it successfully. Let's recap what we've learned about investing in the stock market. As we've discussed, investing is a journey that begins with understanding the basics of the stock market. The market is a dynamic, ever-changing entity that represents the collective decisions of millions of investors. It's a place where companies sell shares of their businesses to raise capital, and where investors buy and sell these shares in hopes of making a profit. Getting started with investing is all about taking that first step. It involves setting clear financial goals, understanding your risk tolerance, and choosing an investment strategy that aligns with these. Whether you're saving for retirement, a down payment on a house, or your child's education, having a clear goal in mind can guide your investment decisions. Researching stocks is a crucial step in the investment process. It's about understanding a company's financial health, its competitive position in the market, and its potential for future growth. This requires a thorough analysis of a company's financial statements, industry trends, and economic factors that could impact its performance. Understanding risk and reward is a fundamental aspect of investing. Every investment comes with a certain level of risk, and generally, higher potential returns are associated with higher risk. It's crucial to assess your own risk tolerance and ensure that your investment choices reflect this. Diversification, or spreading your investments across different types of assets, is a common strategy to manage risk. A comparison of long-term and short-term investing reveals two distinct strategies. Long-term investing involves buying and holding assets for several years, with the expectation that they will increase in value over time. This strategy is often associated with lower risk and is suitable for investors with a longer time horizon. On the other hand, short-term investing, or trading, involves buying and selling assets over shorter periods, often within a single day. This strategy can potentially yield high returns, but it also carries a higher level of risk. Avoiding common mistakes is key to successful investing. These include chasing hot stocks without proper research, letting emotions drive investment decisions, and not having a diversified portfolio. It's essential to stay informed, make rational decisions based on sound research, and maintain a diversified portfolio to mitigate risk. In conclusion, investing in the stock market can be a rewarding endeavor if approached with knowledge, planning, and discipline. It's a journey that requires continuous learning, patience, and a clear understanding of one's financial goals and risk tolerance. Remember, investing is a journey. It's not about where you start, but where you end up. Happy investing!